historically low interest rates and looser bank lending restrictions have spurred the fastest rise in mortgage lending in 5 years. And the media's been full of the news about this. Some commentators are excited by the fact that lending has increased by 4%, but that's of course after the Reserve Bank dropped interest rates and APRA loosened its lending criteria. Other commentators are warning that the prices of properties are going to keep increasing now. We're going to head into another dangerous property bubble. So what's really going on? Is this good news? Isn't it? What's happening? To better understand what's happening on the ground, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Welcome, Andrew.
Welcome, Michael. And the bubble is back. Guess nothing will stop a cheap headline, and that's about the cheapest headline you can get going around. But not sure it makes a lot of sense. As it really
didn't take long for it to come back, did it?
Yes.
And it's because, as I explained, the July figures for the Australian Bureau of Statistics and Finance suggested that owner-occupier lending jumped almost 10% in 2 months. Investor lending has increased as well, 4.7% in July. However, as a share of their total lending market, they're still very low. And also first home owners are joining the party, and that's even ahead of the first home buyer deposit scheme that's happening in January. Maybe they're a bit concerned they're going to miss out. So these figures seem to suggest that the combination of increased confidence, re-election of the Morrison government, to interest rate drops, APRA's loosening of lending, are all having the desired effect. But is that really what's going on, Andrew?
Well, it's what's going on, Michael. Obviously, that lending data from the ABS does tend to be backward-looking. We're well into September now, of course, and that data does reflect July. Now, we've had other more forward-looking indicators of housing market activity that have shown us quite strong results. Clearance rates in most capital city markets are strong. Melbourne and Sydney boom time levels, and stronger in Brisbane, Adelaide and Canberra. We've seen asking prices increase almost across the board over August, and other price models have shown increases over August as well. So this really validates those indicators in terms of strong results over July for home lending.
Well, some people are getting excited that investors are back in the market, and they're suggesting those very high auction clearance rates, together with more lenders borrowing money, is going to create double-digit growth. But really, investor activity is still in the doldrums compared to a year or two ago, as your graph here clearly shows.
Well, that's right, Michael. I mean, it was an across-the-board increase in activity, but investor activity remains at the lowest level in 10 years, and actually the second lowest level on record in terms of market share. And we know that it's still tough to get a loan if you're an investor, but not as tough as it was. And investors will be interested more and more in the marketplace as prices start to rise. So any speculation about double-figure growth, we've sort of gone from the doomsayer to the boomsayer mantra now in media land, and we've had analysts who were predicting double-figure declines in house price growth this year and now starting to predict double-figure house price increases. So it really is cloud cuckoo land, but it's something we should get used to. I think the Reserve Bank has placed itself a corner here, because what will they do given their obsession with this mysterious bubble entity that's supposedly be dangerous to our housing markets and economy? If we do get strong growth, does that mean they curtail much needed declines in interest rates or stimulus to the economy, particularly when we've got unemployment prospectively on the rise? So beware the law of unintended consequences. And this is the outcome now for what has been highly questionable policies from the Reserve Bank and APRA over the last 3 or 4 years, which of course are now strongly in reverse.
Well, owner-occupiers make up the bulk of the market, but the big booms and then the downturns, the extremes of the market tend to be led by the property investors. So at those times when we had significant growth in Sydney and Melbourne, double-digit growth, investors were making up 40, 50% of all the loans in Sydney, even a higher percentage at one stage. And sure, that was unsustainable, but we're well below average investor lending and investor activity in the market. So I can't see the market having double-digit growth for some time yet. Having said that, first home buyers are back in the market now too, Andrew.
Well, that's right, Michael, and that's obviously always good news to see young Australians particularly realising the great Australian dream, despite warnings about the declining levels of home ownership on a generational basis, and plenty of motivation for first home buyers. Higher prices are poison for first home buyers. That's why we see fewer first home buyers in the marketplace in a strong market where prices are rising because, of course, first home buyers don't bring a trade-in into the marketplace like typically an owner-occupier does. They have to rely on their savings, and as prices rise strongly, moves ahead of their capacity to stay in the market through saving for their deposit. And the other factor, as you mentioned, was higher prices always attract more investors that push up prices, and so it goes on. I'm not sure it's unsustainable. Our price growth is typically fenced in by interest rates and lending conditions, which are typically quite tight in this country, despite a lot of nonsense that goes around about over-borrowing. But with fewer investors in the marketplace now, it's a good time for first home buyers, as we've seen, with them surging back into the marketplace. But as prices rise, they will find it more difficult. And as investors also move into the marketplace in higher numbers, they typically compete for that first home buyer product.
Really, one of the reasons we're able to borrow more is interest rates have dropped. And another is because APRA has lowered the lending criteria to make it easier for banks to lend money. But not that long ago, Westpac was taken to court because of the question of were they actually giving responsible lending and letting people borrow more than they should. And I remember the judge actually said, hey, that's not right. If somebody wants to wash down their meal with Grange and eat Wagyu steak, that doesn't mean they can't meet their loan requirements. It means that if you do take on a loan, if you do lose your job, if interest rates go up, Australians are pretty good at hanging on to their home. They'd rather swap their Wagyu beef for dog food and keep their homes. And so all of a sudden it looked like, hey, the banks are going to be let off the hook and allowed to make sensible decisions about what we could borrow. But I've just now heard, Andrew, that this is now going to a High Court appeal, and it may be that it's going to be tougher to borrow again. I don't think that's what we want, is it?
Look, it's cloud cuckoo land in this country in terms of our perspective on our housing markets. Our housing markets are world leaders, Michael, are robust and resilient through the cycles, and it is because our banks have significant market power. This is no secret, and it's no great to have any sort of great depth or insights to see this. And that's why we have low levels of mortgage defaults and mortgage arrears, which typically track the unemployment rate, which is no surprise. We seem to be completely absorbed with the fairy tale. The big bad wolf is the bubble. The big bad wolf is all these terrible risk outcomes that could happen, or risky outcomes that could happen through a robust housing market. There's no historical evidence whatsoever to support any of these models that APRA and the Reserve Bank and others have made in terms of a volatile and unstable housing market in prospect. And this is why they've got into trouble. Again, we're still seeing this obsession with over-managing the potential for this so-called risk to house prices and housing market lending, which only creates the risk that it's supposed to avoid. And we've seen that over the last 12 to 18 months with this unprecedented credit squeeze and buyer's strike that was a consequence of these cloud cuckoo land policies and attitudes.
Well, the risk, I understand, is mortgage default. People can't pay their mortgages, they get over their head. But Andrew, is that the case? What's the state of mortgage default at the moment?
Well, it's still low. It's traditionally always been low, Michael, as I said. The fact is that banks don't overlend. They stick to quite a strict criteria. We see that mortgage defaults and mortgage arrears typically rise with higher levels of unemployment on a local level. And the areas which have higher levels of mortgage defaults and arrears are, of course, the states and the capitals where we have higher levels of unemployment.
So in summary, yes, there's extra mortgage lending, but that happened a couple of months ago. So we've got lots of other good signs of the property markets moving forward, but no boom ahead. But always headlines, always good news. So we've got something to talk about every week in this Property Insider series of videos, Andrew.
Michael, we're moving to more of a normalised environment now. We still have relatively low numbers of properties being offered for sale. That will increase as prices rise and vendors become more confident. Buyers are confident, first home buyers are confident, investors are getting interested again. We're getting back to a normal market after what's been a period of interference from policymakers that produced the very outcomes that they were supposed to avoid. So hopefully moving forward, the lessons have been learned and we can just get on to enjoying what is a fruitful, robust and resilient housing market, which I believe is the envy of the world.
You're more optimistic than me. I don't think the lessons are going to be learned, but let's wait and see. Thank you for your time, Andrew.
Thank you, Michael.